In today's video, I'm going to go over some dividend-paying investments that I hold that currently offer yields exceeding 14%. We'll discuss their features, their recent performance, and why I believe they're worthy of consideration for a well-rounded, income-focused portfolio. Additionally, I'll share some insights on the potential risks involved with these high-yielding investments. Because as with everything that offers an above-average yield for a particular investment type, there's usually an above-average amount of risk, which I think there is in the case with these, but I'll explain why despite that, I'm a believer in these investments. So with all that said, let's get started. The first 14% yielding investment that I continue to hold is the PIMCO Dynamic Income Fund, ticker PDI. It's a closed-end mutual fund that invests in fixed income markets around the world. PDI normally invests in a portfolio of debt obligations and other income-producing securities of any type, with varying maturities and related derivative instruments. The fund's investment universe includes mortgage-backed securities, or MBSs, investment-grade and high-yield corporates, developed and emerging market corporate and sovereign bonds, as well as other income-producing securities and related derivative instruments. PDI normally invests 25% of its total assets in privately issued mortgage-backed securities and 40% of its total assets in securities of issuers economically tied to emerging market countries. It's been well over a year since I've covered this controversial holding of mine. As of the making of this video, it's currently up over 16.5% for the year, which is largely due to that massive dividend this fund offers. Right now, PDI comes with a dividend yield of 14.35% according to Google. If you're not familiar with PDI, you're probably wondering why it's such a contentious holding among income investors. If we look at its holdings on PIMCO's website, we can see it holds a lot of risky investments. No doubt the biggest source of concern for many would be the non-agency mortgage investments. These make up 25% of this closed-end fund. Non-agency mortgage-backed securities are mortgage investments that aren't backed by a government-sponsored enterprise like Fannie Mae or Freddie Mac. People usually have flashbacks to 2008 when they think of MBSs. The second biggest source of concern people would likely have with this fund would be its high-yield credit bonds, which again make up about 25% of its portfolio. High-yield bonds, also referred to as non-investment grade bonds, are investments that are rated BBB- or BBB3 by established credit rating agencies. They offer much higher yields than average because there's a greater chance the borrowers won't still be around to pay the lender the full amount of the bond. Finally, one more turnoff is looking at PDI's recent chart performance. You can see PDI is still down massively from a few years ago. The pandemic resulted in a major sell-off, and then as it was still recovering, high interest rates sent the NAV down further. Fortunately for me, I began investing in PDI after the majority of this fall occurred. So why do I still believe in this closed-end fund that's been struggling to regain its share price? Despite the sell-off that took place after the pandemic, PDI has never gone through a dividend cut. Since they created this closed-end fund back in 2012, it's always paid a yearly dividend amount of $2.65 per year per share. Because we're talking about a closed-end fund here, another suspicion that you might have is that they might be relying on return of capital. In the majority of cases, when a closed-end fund is unable to maintain its dividend, instead of reducing it, the management might instead rely on paying out the capital that investors have already put into the fund. And this return of capital could make up just a small percentage or even up to 100% of the total dividend being paid. If they do this for too long and for too much, the NAV will eventually shrink and it'll lead to long-term share price declines. ROC, however, is just a tax classification, and it's not always the case that ROC is the result of fund managers returning capital. We have seen some funds pay dividends that are classified as ROC that's not actually ROC, but they're allowed to classify the dividends that way because of an option strategy. But according to CEFconnect.com, which identifies the source of each dividend, it says their dividend relies on zero return of capital. As someone who's been investing in PIMCO funds for years, I've noticed a trend when it comes to their dividends. When each new year starts, they often report very low dividend coverage. So looking at their UNII reports in February or March can often lead to some anxiety if you don't monitor it very often. But then towards the end of each year, their dividend coverage improves significantly. This has been the case for PDI, where we can see that as of November 30th, their 3-month rolling dividend coverage was close to 100%. It's during the last couple months of each year that these funds tend to fully cover their dividends. Additionally, regarding the MBSs, I mentioned this a couple times in the past. The MBS securities that we see today and the ones that PDI holds are nothing like they were in a pre-financial crisis era. Before the crisis, MBSs didn't have the regulations that we see today, and banks were allowed to issue mortgages without taking reasonable measures to ensure borrowers could afford them. So these holdings are a lot safer today than they were before 2008. With regards to their high-yield credit bonds, I will admit that I am placing my faith in PIMCO on being able to do a good job. Again, their consistent history of paying dividends without cuts attests that their team has done a great job when it comes to picking safer, high-yielding bonds. I've described in previous videos that PDI's portfolio is a bit of a black box. There's no possible way that you can do an in-depth analysis on everything this fund holds. Many of these companies are privately held and they don't make their financial statements public. So although that does concern me to a certain degree, which is a reason why I consider PDI riskier, their dividend consistency speaks for itself. So that's why I've been and continue to be an investor in PDI. I'm more than happy to keep waiting for bond values to go back up and reinvest all my dividends in the process. Another holding that's offering a 14% plus yield is QQQI, the NEOS Nasdaq 100 High Income ETF. This ETF describes itself as a fund that seeks high monthly income in a tax-efficient manner, with the potential for upside appreciation in rising markets. This fund invests directly and through derivatives in stocks of companies operating across diversified sectors and uses derivatives such as options to create its portfolio. This ETF seeks to generate high income from the premiums earned from Nasdaq 100 call options as well as dividends received from the fund's equity holdings. If you watch my channel often, you'll likely know that SPYI is my current favorite high-income ETF, which is by the same company. It's practically identical in terms of strategy, with the only difference being SPYI uses its strategy on the S&P 500. QQQI, on the other hand, uses its strategy on the Nasdaq 100. Currently, I hold a lot more shares of SPYI than I do QQQI, and I get a lot of questions about this. People sometimes ask me, if both ETFs do the exact same thing, but QQQI offers a better yield, why not hold more of QQQI as opposed to SPYI? There's a few reasons why I do this. The first is for diversification. SPYI is exposed to 500 different companies, whereas this ETF is only exposed to 100 companies. The sectors are also much better diversified. Tech makes up over half of the Nasdaq 100 compared to 34% of the S&P. I know the tech boom that we've been going through has been pretty incredible recently, and I have to admit that this is my own personal opinion, but given tech valuations, I think it's inevitable that there will eventually be a sizable drawback in share prices within the tech sector. When that could be is impossible to predict. Tech could soar for many more years in the future. But younger investors likely aren't aware that we went through a sizable bearish tech market for almost a decade at one point. This sector and this index is a lot more volatile than the S&P 500. Therefore, I sleep better at night owning more shares of SPYI than QQQI. But I still hold this 14% yielding ETF, and it's been a really great holding. This NEOS fund utilizes a call option strategy that's a bit different from its peers. It can include both sold and purchased index options, which can provide the opportunity for better upside capture in rising equity markets compared to other CC funds. Because it's an actively managed fund, it seeks to take advantage of any tax loss harvesting opportunities. The management team tries to save its investors money on their taxes by doing this and utilizing something called 1256 contracts, which are subject to lower 60/40 tax rates. So this makes QQQI, in my opinion, the best Nasdaq 100 covered call fund that exists. There's better upside potential, lower downside potential, active management with a lower expense ratio than its peers, and potentially more tax-efficient dividends. So far, it's been an ETF that I've been really pleased with up to this point. And that's going to conclude our look at some 14% yielding dividend investments that I'm a believer in, both of which also pay monthly dividends, which is also great. But with that being said, thank you for watching today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.